Hello, my friends. Today is August 3rd, and this is Markets Weekly. So this week was a very volatile week in markets. We saw tremendous price swings in basically all asset classes. Looking at the S&P 500, after the Fed meeting, S&P 500 was surging. It looks like everything was okay. And then Thursday, we sold. Friday, we sold a lot. And honestly, it was getting a bit scary. However, I continue to believe that the highs of the year are not yet in. So today I want to talk about three things that I think are driving this sell-off and why at the end of the day I'm not super worried, at least not yet. So first, it seems like we have the blow up of two very popular trades in the market, the yen carry trade and the short fall trade. Secondly, we have geopolitical issues in the Middle East that are heating up, and that is having a clear impact on some markets. And lastly, there seems to be a strong bout of recession fears occurring. After we got the non-farm payrolls data, the market really seemed to worry about a potential recession, and honestly, it seems like they're getting carried away. Okay, starting with the two trades. Now, globally, every country has different interest rates. Now, in the US, interest rates are around 5.5%. In Canada, in Europe, they're all, they've been hiking rates for the past few years. However, in Japan, interest rates remain very low. So over the past few years, a lot of people have been borrowing money in Japan, in Japanese yen, and taking that yen, selling it for dollars, and then buying, say, dollar assets, or even selling it for euros and buying euro assets and so forth. Now, over the past few years, people who are in this trade totally hit a home run. So, for example, if they borrowed yen and sold yen for dollars and bought the S&P 500, they would have been up hugely on the S&P 500, and they would have won a lot on the currency trade because the dollar appreciated against the yen significantly. So those guys doing really well. And what tends to happen is when you have a trade that works really well, a lot of people join in, continue to lever up, and it works really well until it doesn't. And over the past 2 weeks, it has not been working well because the Japanese authorities have been doing things that are strengthening the yen. Now, this first happened when the Ministry of Finance in Japan intervened in the markets to strengthen the yen right after the soft CPI print a couple weeks ago. But more recently, this week, the Bank of Japan also became a lot more hawkish. So in this week's meeting, the Bank of Japan did two things. First, they hiked interest rates to about 0.25%. Again, it's still really low, but for them, they are being a bit more hawkish, even as central banks across the world are being more dovish. The second thing they did was they also implemented quantitative tightening. So going forward, the Bank of Japan is going to be shrinking their balance sheet, and that should be putting some upward pressure on their longer dated rates. So again, intervention plus more hawkish Bank of Japan, the yen strengthened. And if you look at a chart of the Japanese yen and say the NASDAQ, you'll notice that they're basically moving together. It seems like what's happening is the guys who are doing this trade, again, the yen is strengthening, so they're losing money, so they close out the trade. Again, when you close out the trade, you're selling stocks and you're buying back the yen. That makes it more painful for other people because, of course, you push asset prices down when it comes to the NASDAQ and makes the yen stronger, and that kind of kicks off a cycle of deleveraging. So I think as people are being basically getting margin calls on this trade is causing a lot of disorder in the market. Now, ultimately, if you look at the expectation of the path of policy for Japan and the US, the interest rate differential is structurally quite wide. So I tend to think that after this washout, this trade will be, again, attractive. Again, if you look at the past couple of years, once the yen strengthened significantly, it kind of went back to depreciating. So let's see if that happens. In any case, this has been painful, I think, for a lot of investors. Another very popular trade that's in the market has been the short vol trade. So as you guys see on the index level, say looking at the VIX, volatility, it was until very recently very low. there have been a lot of people who are selling volatility on the index level and buying volatility on the underlying single stock level, say the Max 7. Now, this has worked really well as index level vol has gone down. Again, VIX was very low until recently, and the volatility on these Max 7 stocks have exploded as you had a lot of people making YOLO trades, and those stocks have also done very well as well. Now, these trades work really well, and many articles in Bloomberg written about them, but then, of course, they blow up when the index vol is spiking and index level vol is spiking. So I imagine there's a lot of people who are unwinding this trade, and as they unwind it, they have to buy back their index level vol short, and that is pushing index level volatility up. Now, you can look at this on a fixed strike basis, or just to be simplified, VIX is a rough approximation. Now, this basically has a chain reaction for many other people in the market because you have a lot of market participants who adjust their risk positioning based on how much volatility is in the market. So let's say volatility is very low, they feel comfortable, things are not moving a lot, maybe they can lever up. But when vol goes up, these guys, they have to cut down their position to maintain the same risk profile. So I'm guessing that as index vol spikes, again, this is kind of a self-perpetuating thing. If you are short index level vol, as it goes up, you have to cover, and forces it to go higher and forces other people to cover again. So that's very painful for them as well. Now, over the past few years, what we've also noticed is that these short vol guys, they always come back because this has been a very good trade. If past is any prediction, I think they will probably come back again. However, if they don't, things could obviously get out of hand. So I guess we'll find out in the coming weeks. Now, the second thing that I think is contributing to this is geopolitical tensions. So now, to be clear, the first thing that dies in war is truth. And so it's very hard to get good reporting about what's happening, say, in the Middle East or in Eastern Europe. Now, we do all know that there was an assassination in Tehran by Israel of a senior figure in Hamas. So what seems to have happened is that as this senior figure was visiting Tehran, there was a bomb in his hotel room that was detonated and he was killed. Now, this really ratchets up the tensions because basically Israel is assassinating people in another country's territory, right? That's obviously very provocative. Imagine if someone came to Washington, D.C. and was assassinating foreign officials. So that made Iran very upset. And in addition to that, Israel also carried out a couple other assassinations throughout the Middle East as well. Now, Hamas, of course, has been in ongoing war with Israel, as does Hezbollah and other Middle Eastern things. Basically, it's kind of always a mess over there. But this latest step has been a next level provocation, and Iran has vowed to retaliate. And I think many people are afraid of an escalating Middle East conference. Now, just this past week, Prime Minister Netanyahu in Israel also came to the U.S. Again, the United States Congress, of course, received a lot of money from Israeli interest, and so everyone there was basically falling over themselves, clapping for Netanyahu. So the perception is that if there's war in the Middle East, the United States will go and send their military and to go and support Israel. So there's a prospect of a very large conflict that also involves the U.S. Again, I don't know if this is a high probability event, but it's definitely something that has been simmering for some time. Now, the news of this has led to a spike in prices like gold, a little bit of a movement in oil, and of course, it's impacting risk sentiment in the broader U.S. markets. So I think that's something that is a tail risk. I have no idea what will happen. I don't think anyone does. I've noticed that it's very difficult to predict geopolitical events, but it's definitely some tail risk that is hurting risk sentiment. Okay, the last thing that I think is contributing to this past week's panic is the prospect of an imminent U.S. recession. So recall, we just got the GDP print for the second quarter, and it was a very strong 2.8%. So growth so far has been very strong. And the labor market has been okay as well. Now, this week, our latest labor market report was a lot weaker than expected. It was about 100,000 jobs created. Now, again, that is weaker than expected, but when you look at the totality of the data, it all suggests a weakening economy. Now, as we usually do, let's not just look at the headline number, but also other aspects as well. So looking one level lower, you'll notice that the unemployment rate surged from 4.1% to 4.3%. The unemployment rate has been steadily ticking higher over the past few months, and it seems to be increasing at an accelerating rate. Now, there's a lot of people who focus on this because there's what's called a sound Dudley rule that notices that when the unemployment tends to rise, it tends to accelerate, and if it accelerates past a certain point, then you are basically almost always in a recession, looking at data over the past few decades. So many people are pointing to this and saying that this indicates that, oh my gosh, the US is in a recession. Now, another thing that was noteworthy in the non-farms payroll was that wages, average hourly earnings, was pretty low at about 0.2% month over month, as low as one of the lowest prints it's had in quite some time. So again, weak job creation, tick in the unemployment rate, and also decelerating wages, all consistent with a softening labor market. The market looked at that and honestly, to my surprise, thought it was very, very negative. Now, sometimes the market looks at good data and thinks that, good data means Fed hikes, that's bad. Sometimes the market looks at data, bad data, thinks that, bad data if it cuts and likes it. But this time the market looked at this data and it thought it was bad and it sold in a big way. Now, one thing to note about the non-farms payroll is that it wasn't all bad. One of the things that stood out to me was that the labor force participation actually increased. So part of the reason why there is a higher unemployment rate is that there's increase in the supply of workers. Now, we've been talking about this for a few months now. The unemployment rate is going to tick higher because we have tremendous amounts of migration, even as labor demand is softening. So this is all consistent with increasing supply of labor, pushing up the unemployment rate. So this is something that doesn't usually happen. So I'm not as worried about this. And if you look at the GDP nowcast from the Atlanta Fed, it continues to suggest very strong growth. But obviously, if you add millions of people a year, that's going to put upward pressure on the unemployment rate because more people are looking for jobs. Now, the market had a very, very strong reaction to this. So strong, in fact, that I think it's kind of crazy. So again, after the Fed meeting on Wednesday, the market was pricing in 3 cuts. The market is now pricing in 4 cuts. A lot of people are saying the Fed has to cut by 50 basis points in September. If you look at the 10-year yield, totally imploded. So not too long ago, it was at 4.2%. Now it's comfortably below 4%. So it seems like there was a very strong reaction that everyone is finally jumping in on this imminent recession trade, rate cuts, and so forth. There are even whispers of an intermediate cut, so the Fed cutting before the September meeting. And let me tell you, that is so outrageously insane that you have to be taking crazy pills to think that. Now, the market, let me just remind you, in January, the market was pricing in 7 cuts this year. So the market is not very smart. Market is honestly kind of dumb sometimes, and it's always very eager to price in cuts. And remember, if you've been following me for the past few years, market has been totally wrong. Interest rate market, bond market, totally wrong about transitory inflation, about higher for longer, and I think it is totally wrong here as well. Now, we had some Fed speakers come out Friday addressing the unemployment report. Mega Dove, Austin Goolsbee, nothing in his comments suggests that we're going to have an emergency cut. Honestly, it's one data point. And some people would also point out that we had a big storm in Texas that might be impacting this. Now, the BEA, the agency, is telling you that they don't think that had an impact. But if you look at the underlying data, it does seem to have some impact on the responses. In any case, this is one print, and we have to watch for upcoming prints to see if this really is a trend of weakening. Now, the labor market is definitely weakening, but I think the unemployment part is being exaggerated by migration, and that's throwing off a lot of commentators. For all I know, and I suspect this will be the case, is that one of the things that's special this time around is that we are starting at 5.5% interest rates. There's a lot of room to cut. And as the market prices in more cuts, I suspect that the market will again come to see low rates equal higher equities. But I guess we'll figure that out in the coming weeks. Again, we are only in the beginning of August, and there's a lot of things that can happen between now and December. At the moment, I am not yet worried. All right, so that's all I've prepared for today. Thanks so much for tuning in. Remember to like and subscribe. And if you're interested in hearing more about my thoughts, check out my weekly blog at fitguy.com. All right, guys, talk to you all next week.